can you prepare me that income statement?
Wait. Prepare the what? Hello everyone, Victus CPA here. Welcome to my channel, Accounting Masters. The second piece of key financial statement we need to know is called an income statement. If you haven't checked out my previous video on balance sheet, which is another key piece of the financial statement, you can click on the link at the top right hand corner. What is an income statement? Income statement nowadays is called Statement of Comprehensive Income, but as we are used to calling it income statement, so we will just use the old name. So the income statement formula involves the two types of accounts, which is income and expenses. So it is very simple. Income minus expenses equals profit or loss. As mentioned in the previous video, the income statement's net profit or loss calculated for the year will be closed off and transferred onto the balance sheet in the equity section called current earnings or loss. Here we can see this example. That is why for every new accounting period, the beginning balance for the income statement accounts are 0. They do not have an opening balance as they have been closed off the previous year. Unlike the balance sheet where their balances are brought forward from one year and carried forward to the next. The income statement are prepared using the accruals concept, also known as the matching principle. What this means is that the income and expenses are recorded as they are earned and incurred regardless of whether if they have been paid or not. For example, if you're a retailer or a trading company and you purchased 3 sets of TVs for resale and one of your customers bought 2 sets of TVs from your company, you can't just deduct 3 sets of TV from the inventory, as not all of the goods purchased were sold in that particular financial transaction. Due to the accrual basis accounting and the matching principle, you will need to match the revenue earned to the cost of goods sold deducted from the inventory. Therefore, 2 sets of TVs should be deducted from the inventory and moved to the expenses account called cost of goods sold. The key point is that you do not want to overstate or understate the revenue or expenses account, but to record them as they incur during that time period. So this is an example of an income statement. Joe's Electronics Limited, Statement of Comprehensive Income, which is the income statement, for the year ended December 31st, 2022. So we see that it says for the year ended because it is just showing that period for that 1 year. It is unlike the balance sheet where it says as at, because for the income statement we are just doing it 1 year at a time. So just looking at this income statement here, we see that revenue minus the expenses, we have a net profit of $192,550 for the year of 2022. Now let's look at the first part of the income statement, which shows the gross profit or loss equals to sales revenue, the net amount, which is also called the top line, minus the cost of goods sold. So the gross profit here, we see that is $340,500. And the gross profit ratio for 2022 is 58%. And we get this 58% by just simply dividing the gross profit divided by the revenue. So the gross profit is the profit a company makes after deducting the costs associated with making and selling its products or the costs associated with providing its services. This is before deducting any operating or administrative expenses. The higher the ratio, the better, meaning that the company has a high ability in generating sales and managing the cost for goods sold very well. So we see that for Joe's Electronics Limited for 2022, the gross profit ratio is 58%. And again, calculating this ratio is simply dividing the gross profit by the sales revenue. And this is very consistent with 2021, which the gross profit ratio was also 58%. Cost of sales are expenses that are directly related in producing sales revenue. For example, for a fitness center, the trainer's salaries will be included in the cost of sales. For a retailer, the cost of sales will be the cost of the product that was purchased and then now sold to a customer. So for this example here, we see that Joe's Electronics Limited, their revenue is basically selling computers and computers accessories. And the cost of goods sold is basically they buy their computers and computers accessories from their suppliers, and then they resell it in the store. So the second part of the income statement shows the net income or loss. This is called the bottom line as it is at the bottom of the income statement. So the formula for this is gross profit minus the administrative and operating expenses. What's under administrative and operating expenses? Let's look at this income statement here. We see that advertising, accounting fee, bank charges, cleaning fees, computer and internet, depreciation, insurance, printing and stationery, rental, repairs and maintenance, salaries, sundry expenses, telephone expenses, travel expenses, and utilities. So these are all expenses that help the company generate revenue, but do not directly generate the revenue where the cost of goods sold does. But without these operating expenses, the company cannot function and generate these revenue. These are just some of the examples of the operating expenses. Depending on the company and which sector they're in, there are different kinds of operating expenses. But these are just the most commonly used ones. So now back to this example, we see that the gross profit, $340,500, subtract the total administrative and operating expenses, $147,950, we get the net profit of $192,550. So again, near the bottom of the income statement, same as the balance sheet, it will say the accompanying accounting policies and explanatory notes form an integral part of these financial statements, meaning that there are notes to financial statements usually found at the back of the financial statements to explain some of these figures on the income statement and their accounting policies. Just to recap, the gross profit or gross loss is calculated by subtracting cost of goods sold from the net revenue. And net income is the profit earned by a business after all expenses have been deducted from the gross profit amount. Now you'll see that some income statements will show EBITDA, EBITDA, which basically means earnings before interest, taxes, depreciation, and amortization. These accounts are not the operational costs that affect the company's core profitability. EBITDA is a popular used measure for core corporate profitability, direct costs in generating the revenue. EBITDA is calculated by taking the net income and add back the interest, add back the taxes, add back depreciation, and add back the amortization. I will be explaining these terms in my later videos, so stay tuned. So in this case, here, Joe's Electronics Limited. How do we calculate the EBITDA? Right, we look at the operating expenses account here, and we see that only depreciation applies. We do not include depreciation into the EBITDA. So what we have to do is we take the net profit, $192,550, and we add back the depreciation of $42,000, and the EBITDA will be $234,550. And that's the income statement. If you found this video useful to you, please give it a thumbs up and comment down below. And don't forget to hit that subscribe button and share this video with anyone who you think can learn from it. In the future videos, we will be talking about charts of accounts, bookkeeping double entries, general ledger, and trial balance, which are all important topics in bookkeeping and accounting, so be sure to check that out. Thank you.